Hey, how are you?
Very good, actually. Thank you. How are you?
Very good. Are you ready for what's coming?
Sure, let's go ahead. Let me just get this out of the way.
What were you doing when we came?
I was just cashing in my earnings from a last stock option trade.
That sounds great. Can we do this as well?
Sure, everyone who can trade stocks can trade stock options.
What is a stock option?
Well, the stock option is a privilege. It's a kind of a forward contract. It's sold by one party to another, and it gives the buyer the right, but not the obligation, to buy or sell a predetermined amount of stock at an agreed upon price called the strike within a certain period of time.
That sounds interesting. Should we go to a classroom to discuss this?
Yeah, let me show you what I mean.
Okay, so what's the story behind this?
Okay, story time. Once upon a time, there was a very productive farmer called Eric. Now, Eric sold wheat to Dorian every year. He sold him 120 tons of wheat every year. They did that for the market price of wheat at that certain day. Now, Eric was not quite satisfied with this because he could not plan. He did not know how much he would get for it. So he went to Dorian and they made an agreement. Eric's agreed upon selling Dorian 120 tons of wheat in 1 year for the predetermined price of $150 per ton. Now, there's no backing out. This is an unconditional forward contract, or also called future. Now, Eric went home, he went to sleep, and one night he woke up and he was like, oh, but what happens if I cannot deliver, if a storm destroys my harvest? He could not sleep anymore, and he did the only thing he knew what to do. He went to Fudd, the wisest man in village. And Fudd actually proposed the following deal. He said, okay, let me do this. I will give you the right to buy 40 tons of wheat for a predetermined price as well, $150 per ton, in about a year's time. So if you need it, you can have it. If you don't, you just don't buy it. So this is a contingent forward contract, or what we would call an option.
Whoa, what a lovely story. Did you come up with it yourself?
Well, I had some inspiration.
Okay, remind me again. What are we talking about?
We are here talking about the option. This means the right to either buy or sell at a predetermined price, a predetermined amount during a certain period of time.
All right, so what type of options are there?
There are two options. It's either called call option or put option.
I have an exam on that tomorrow. Can you explain that to me?
Sure. So the call option gives you the right to buy a certain stock at a predetermined price, whereas a put option gives you the right to sell a certain stock at a predetermined price.
Sounds interesting. So for what kind of underlyings can you buy this option?
Well, there are lots of underlyings that you can buy it for. The most common are stocks, but you can also buy it for currencies, indices, or whole baskets. As long as there's someone willing to sell it to you, you're able to buy it.
You mentioned a strike before. What exactly is that?
Well, the strike is the predetermined price that you're going to buy or sell. In our example, it was this $150.
You were always talking about a period of time. Why is that?
Well, unlike stocks, you don't hold an option into eternity. It has an expiration date. And once it reaches this expiration date, its value is nothing.
That sounds like a huge disadvantage. Why would anyone still buy this?
Well, you're right. The risk is higher, but normally the return as well. And you are able to control a larger amount of stocks with a smaller amount of investment. This is called leverage.
Is there a way to calculate leverage?
Yes, there is, and it's called omega. So the leverage that you have is the percentage change in the price of the option divided by the percentage change in the price of the underlying. And let's say you have an omega of 8. That means that when the underlying changes by 1%, your option increases by 8%. But this also goes the other way around.
This all sounds very complicated. Can you make an example?
Sure, let's go. All right, so let's assume we have Hang Dong investments. time is 0, and the share price is 100 US dollars. You want to make an investment of 1,000 US dollars. You now have two options. Option A, you buy 10 shares for $100 each. Or what you can do, you can buy 5,000 options for 20 cents. The strike of these options are 110 US dollars, and the ratio is 10 to 1. This means with 10 options, you can actually move, or you can actually use one share. So now it's time 1. Let's assume that the price rose to 105 US dollars. If you chose option A, you have now 10 shares that are valued at 105 US dollars, which gives you a profit of 50 US dollars or 5%. Let's assume that the options went from 20 cents to 28 cents. This gives you now a wealth of 1,400 US dollars, which is 40%. So you see the omega here is actually 8. For every 1% that the share went up, your options made 8%. 5% makes 40%. But you have to think about it this way as well. It can also go in the other direction.
Oh, okay. On an unrelated topic, what's your favorite stock?
Lindt & Sprüngli, the Swiss chocolate manufacturer.
Why?
Well, each year you get a paid out dividend of 3 kilograms of chocolate. Best Swiss chocolate.
I want this. How can I get this?
Well, you can buy it in the stock market. It's valued at 5,555 Swiss francs right now, which is approximately 4,750 euros.
All right, I'll think about this. Back to business. What do you do with the options once you buy them?
Well, there are 3 alternatives. Either you resell them at the market. This is what most people actually do. Or you wait and you exercise your right. Or if you don't want to do anything of this, you can just let it go to no value at the end of the term.
Hey Jonas, can you please answer me some questions?
Sure, I'd love to.
How would you use stock options?
Well, there are 2 main incentives. One of them is investment, the other one is hedging.
Alright, that makes sense. But what are all these graphs here?
Well, these are called payoff diagrams.
What do they show?
They show the return you have for the certain price of the underlying for the 4 basic strategies in option trading.
And what are those?
Well, you have 2 decisions to make. The first one is, do you want to go long? That means you buy the option. Or do you want to go short? Meaning you sell the option. The other choice is if you want to go with a call option or a put option. So you have 4 combinations, ergo 4 strategies.
That makes sense. Can you explain how these graphs work?
Sure. Let's go over here. This is called a long call. So let's assume the strike price is 90 US dollars. You pay $3 as a premium for one option. So if the price of the underlying is below 90, you are actually in a loss. So you lost $3 per option. Now, once it starts getting over 90, your loss decreases. And once you reach 93, which is the strike price plus the premium, you're at the break-even point. And if the price increases even more, you're in your value option. You gain actually money. You make money. The other one here is called a short put. So let's assume again, strike price 90, premium 3 US dollars. You now sell, as it is a short, you sell the put option. So while the price of the asset or of the underlying is above 90, you actually make money because no one's going to exercise their right to sell for 90 if they can sell for 95, for example. Once the price starts decreasing, your value or your gain starts decreasing as well. And once you hit 87, this is again the break-even point. If the price decreases even more, you come into your loss range, and you have a limited loss of 87 per stock that you sold.
So in what market does it make sense to use options?
Well, basically in every market. You can illustrate every market by using stock options.
And what do you do if you expect an increase in price?
Well, if I expect an increase in price, I either go with a long call and get all this here, or I go with a short put and just get the premiums.
And what if you expect prices to decrease?
You don't. You do actually the opposite. You either go long put, so you can make money here, or you go short call because no one is gonna exercise this right then.
Okay, and last option, what if prices gonna stay the same?
Well, if they're gonna stay the same, you're basically just gonna short it, so you're gonna sell the option. Because if prices are gonna stay the same, no one's gonna exercise the right because the strike will not be reached, either if it's above or below.
Okay, thank you, Jonas.
You're welcome.
What would you do if you had to invest in cryptocurrencies?
Well, that's a tough one, but I think I would buy a long put because, trust me, that ship is gonna sink at one point.
Very good. We're almost done. One thing though. Can you show us a real life example?
Sure, let me show you. Just follow me. All right, let me show you this. All right, the first thing you want to do before trading stock options is actually finding the right product. As you're going to see, there are a lot of different products on the market with different characteristics. Standardized options for trade are called warrants. In order to find the one that you want, you might use a search engine. The one depicted here is just an example. So let's start. We're going to choose our type of underlying. In this case, we're choosing equity, which basically means stock. Then we choose the region we want to invest in. Uganda? Oh, no, please no. I would rather wash my money down the drain. Let's choose the United States of America. Now let's assume in your finance class you were convinced that the price of the Amazon shares are going to rise. So we're going to look for Amazon here, which should be somewhere here. There you go. And as we said, it's going to rise. We're going to look for a call option. As you can see, you can also fill in a range of strike prices and maturity dates, depending on how exact your ideas are. Then you can filter the issuers as well. This might be important as by buying such a product, you're also exposed to the issuer's risk of default. We're going to go with the only banks you can trust here, UBS and Vontobel. So let's look what we can come up with. As you can see, there are a lot of different options here. Mostly they're different in their strike prices, bid and ask prices, and maturity dates. Let's just choose one, this one right here. So as you can see here, you see bid prices, ask prices, you see spreads, you can see the strike prices down here, the option type, the multiplier or ratio, what kind of option it is. You find a lot of different details. But remember, this here, you cannot trade over this site. So what you want to do is that in order to trade this product, you copy the ISIN, the International Securities Identification Number, and you place the order with your bank or your broker. Going back to the data, there's a beautiful illustration on how much more this option type actually fluctuates than the underlying. If we compare this, the underlying in the last 3 months went from 800 to 950, which is approximately a rise of 18%. The option, however, went from almost 0.025 to now 0.17, which is an increase of over 500%. Thus also explaining the omega that we have of 28. And remember, an omega of 28 means that if the underlying increases by 1%, the option actually increases by 28%. You can also find other interesting calculations like the implicit volatility that... Wait, but you don't care about that stuff. You only care about one thing. Is this all legal? Absolutely fucking yes. So get up your ass, get out there, and start making some fucking money.
All right, I think we've got everything we need to start trading options. Any last advice?
Well, stock markets are a funny thing. When some person sells, another person buys, and they both think they're smarter. So just try not to be the dumbest, and you will be fine.
Thank you so much.
Thank you.